Covered calls and cash-secured puts are not risky tricks. They are disciplined income strategies when used on stocks you are willing to own long-term. This is not about beating the market or predicting every move. It is about getting paid for patience, structure, and planning. For educational purposes only, not financial advice. Welcome to Epic Money Mindset, the place where ambitious people come to master money, build wealth, and create real, lasting financial freedom. Covered calls and cash-secured puts should be viewed as pricing tools, not speculation. They only work when one condition is met. You are genuinely comfortable owning the stock, or buying the stock, if assignment happens. If assignment would immediately make you angry, stressed, or glued to your screen, the strategy was misused before it even started. It is also important to understand that these strategies operate in blocks of 100 shares. That means real capital is involved. If a stock trades at $100, you need $10,000 in capital. The quality of the company matters, but so does whether tying up that much money makes sense for your portfolio. A covered call means you already own 100 shares and sell a call option against them. You collect cash up front and agree to sell your shares only if the stock reaches a price you already approved. Think of it as renting out your upside. You get paid for it, but you are giving something up in return. One downside of covered calls is that your shares are effectively locked up while the option is open. You cannot freely sell the stock unless you first buy back the call option. If the stock starts moving higher faster than expected, the call increases in value, making it more expensive to close. That is the trade-off for collecting premium up front. Another downside is capped upside. If the stock explodes higher, you do not fully participate beyond your strike price. This is not a flaw in the strategy. It is the cost of choosing income over unlimited upside. Covered calls work best when you are comfortable trading some upside for consistency. Imagine owning 100 shares of a stock at $100, requiring $10,000 of capital. You sell a $110 call and collect $250. If the stock stays below $110, you keep the cash. If it rises above $110, your shares are sold at that price and you still keep the premium. But if the stock suddenly runs to $130, you do not get the extra upside. That was the deal you made up front. A cash-secured put has a different, but equally important, downside. When you sell a put, you are committing to buy the stock at the strike price if assigned. If the stock drops well below that price, you are still obligated to buy at the agreed level. Assume a stock trades at $100 and you sell a put at $90. You collect $200 and set aside $9,000 in cash. If the stock drops to $80, you are still buying at $90. The premium helps, but it does not eliminate downside. This is why selling puts on stocks you truly want to own is critical. Cash-secured puts also tie up capital. That cash is reserved while the option is open and cannot be used elsewhere. The income is real, but the opportunity cost is also real. The key to managing downside is planning before the trade, not reacting during it. Before selling any option, decide what would make you uncomfortable. Ask yourself how you would feel if the stock dropped sharply or moved far beyond your strike price. If you do not like the answer, adjust the trade or do not place it. Cutting losses in option strategies is less about panic and more about rules. Some investors choose to close positions early if a loss reaches a predefined level. Others adjust only when the original reason for entering the trade no longer applies. The important part is that the decision is made in advance, not in the heat of the moment. For covered calls, One approach is to avoid selling calls at prices where you would regret losing the shares. Another is choosing shorter expirations, which limit how long your shares are locked up and give you more flexibility. For cash-secured puts, risk is managed by position size, strike selection, and willingness to hold the stock after assignment. These strategies are not designed to avoid losses entirely. They are designed to make losses manageable and intentional. When something goes wrong, it should be because the market moved, not because the plan was missing. If you want to explore these strategies yourself, you can check the Robinhood link under this video to see how the platform works. Covered calls and cash-secured puts are not shortcuts or get-rich-quick tactics. They are structured systems for disciplined investors who value consistency over excitement. When paired with quality stocks, proper capital sizing, and a clear plan for downside, they can create cash flow while you hold or while you wait to buy, without constantly guessing what the market will do next. Thank you for watching Epic Money Mindset. If this brought value to your life, stay connected and pass the insight forward. I'm grateful to have you here, and I'll see you in the next video.